So I want to start this video with a story. When I was new in the industry, I was working at a firm where I designed products for corporations. Executive benefit planning, the firm had experience in designing BOLI products, high net worth individuals and corporations, maximum cash value life insurance products. But what was interesting is the firm was working with a construction company, and I was designing policies with different insurance companies for maximum cash value for the firm, for this company, their potential client at the time. And the owner of this construction company had owned whole life insurance. In fact, he had about 7 policies, I believe. And what was so interesting is he stated that, when it comes to whole life insurance, because this is what they had looked at for the company, he said, when it comes to whole life insurance, my life insurance policies, aside from my ownership and my share in my own company, my life insurance policies have been my best performing asset. Aside from my real estate investments, stocks, bonds, everything else, when I look at my life insurance policy, I'm 30 years into the products now, I make a premium payment of $12,000 in one of them, and I see the cash value growth over $40,000. It's like, hey, sign me up. And what was interesting about that is we got to see a policy, a situation where it actually worked. 30 years old, real performance, and he actually shared those policies. We got to break them apart and look at the net internal rates of return. It was really interesting. I had a lot of fun on that, but I'm going to try not to get into all the details here, at least not on this point. So the point of that story is the whole life insurance product specifically designed for cash value for this individual that did very well, had a construction company that was very profitable, and looking at policies on a number of their executives, it gave him peace of mind. No matter what happened in the economy, in the stock market, that product just continued to move forward. And that is what was very, very attractive to him, what had really solidified the deal for him to look at whole life insurance as an asset on the company's balance sheet, because he had successfully used them. He had a positive experience with his own personal policies. So this product can provide great peace of mind. Now, setting it up properly, if your goal is cash accumulation, how do we maximize the cash value? Not necessarily the death benefit, at least not right now, because we want to be able to use our money. Setting it up properly is very important. But if it is set up properly, it will definitely provide peace of mind. So some things we want to touch on here are as follows. With the cash value, so a cash value life insurance product, safe, liquid, tax-free area to position money, and the net internal rate of return may fall between 3 and 5%, typically 3.5% to 5.5%. IRR, again, represents internal rate of return. And what I want to just clarify here is that represents the actual cash value performance, the actual growth over time. Because often what we see is a company declare a dividend rate of 6%, and that's what a policyholder or consumer will think that they're earning, which is not the case. Whenever we see a dividend rate or a guaranteed rate of 4% for that matter, what is important to be aware of is that that is a gross rate that is credited after the company's insurance expenses and mortality charges. It's a fixed asset. So many companies consider cash value life insurance as an asset class. Again, the 3 to 5% net. Tax benefits here, we've got a handful of them, but specifically around the cash value and death benefit, here's how they work. On the cash value, if we set a policy up properly, if it does not become classified as a modified endowment contract, if we do not cash it out with a gain, if we don't let it lapse with a large loan balance and we've pulled out more money than what we've paid in, there's certain instances where we could trigger a taxable event. But if we do everything right and use the policy properly, if you've got someone working with you, an agent that knows how to avoid pitfalls, or you're educated on it, that cash value can be used tax-free. That is such a huge benefit and why so many people are attracted to these products. The death benefit is also paid out tax-free. Now, an important point to mention here, or to clarify, is death benefit proceeds are always paid out income tax-free, not estate tax-free. So if I have a very high net worth and if I leave an inheritance or assets to the next generation, there's going to be an estate tax there. Maybe I'm leaving $50 million, a large amount. That's often where you will see special trusts set up or something designed where that death benefit is owned not in our name, but outside of our name, outside of the estate, I should say, typically in some type of trust. But that's where we'll involve an attorney, someone who's very good at that. Not myself, because we can't set up trusts, but we can set the policy up and work with an attorney, no problem. Couple other things. Here is a very, very valuable piece. Premium flexibility. Flexibility around the amount I want to pay in, and then also the time period. So we often talk about this. If I want the ability to pay in $100,000 per year, does that mean I get a bill for $100,000 every year? Absolutely not. If it's set up properly, absolutely not. You can easily design it where we have a $10,000 minimum premium. Some companies will even allow you to go lower than that. And then at your discretion, you can add more funds towards the PUA component, therefore optimizing the cash value growth, which is exactly what we're going for. How do we juice that cash value and get things moving so I've got access to capital and it's going forward, not backwards. And then this kind of sums it all up or ties everything together with the story. It allows one to focus on everything else. So a lot of people like having money in their bank account. My friend Dr. Ace will refer to himself often as a cash cow because it can just pile money. He knows it's there, it's safe, it's liquid, all that good stuff. Now the problem with a bank account is a lot of times we can put money under our mattress because it doesn't pay that much right now, whereas a life insurance policy does. So where can I put my money that is safe, liquid, tax-free? That way I can focus on my business. I can focus perhaps on growing a real estate portfolio, eliminating debt, other investments, let's call it life. I can focus on other things, unlike the stock market where you may have mastered the stock market. When I say mastered it, meaning not having to be concerned about your money going up and down, losing it. You can do very well in the stock market. I'm not saying stay away from that. Most people we work with are well diversified. They like working, they like putting money in the market as well. But if you want that peace of mind product, this helps. Call it worry-free. And I've got the money accessible to take advantage of opportunities when they present themselves. Money continues to compound over time. Unique loan feature. This has to do with the liquidity. Regardless if I touch my money or not, if it's earning, call it 5%. Doesn't matter if I leave it all in cash value or if I borrow against it, I continue to get that 5% on my entire bucket of money. So let's look at a couple examples here just to demonstrate the peace of mind product and really how it would work. So the policy design is always important. If you've ever been exposed to whole life insurance, here we've got a 40-year-old male. Why whole life? On the left, traditional policy, 100% base premium, paying $20,000 in per year. There's his cash value right off the bat, 0. Builds equity really beginning year 3 and 4. But what is highlighted in yellow down here is when he has more money than what he's paid in over the past 14 years. Paid in $280,000 and now he's got $287,000. That's a long time. Compared to the same insurance company, same individual, same out of pocket, but redirecting where the money's going, $20,000 per year, $2,000 minimum base premium. So this is our 1090 split here. We've got a term rider in here too, but we're optimizing the cash value. So of that $20,000 minimum premium, $17,000 plus right off the bat, a little over 85% of our payment in equity, and breaking even just about year 4, where I've paid in 80 and I've got 79.8, and it continues to perform over time. Same company, same assumptions, same health rating, all of that good stuff is identical. And if you're on our membership program or would like to see the detailed illustrations that come directly from the insurance carrier software, that's all disclosed on there. This way we've got full transparency. Point being here is here we see the policy design. So Again, back to the peace of mind product. If I want to have peace of mind and see my money show up, designing the policy properly is very important. Now, if I'm looking at it as a fixed asset, one of the bullet points, I want to plop money in here, see it grow, have access to it for an opportunity, but I don't want to be committed to payments. I want to see the growth there. I also want to see guarantees. What will that look like? Well, here's an example of someone with a lump sum of money, $1 million total, 40-year-old male, and here we go. Moves the million into a policy over 4 payments. You could consolidate this quicker, but whenever we look at lump sum payments, we do like to spread it out, and a big reason why is premiums are always going to be due for at least 7 years, so it's still due here. He's not paying anything, the policy's paying for itself. But from stress testing the policy, I want to make sure that it continues to grow, especially if I don't plan on paying anything, based off of the present interest rate environment, present dividends, but more so the guarantees. Like I want to make sure in a worst case scenario, whoever we're working with, their money keeps going north, not south, and does not flatline, because then it's like, what's the point? I got a death benefit, but if the cash value was your point of interest, well, let's make sure we hit all the important points on cash value. Break even between years 3 and 4. Now, a couple things here. On the right, annual internal rate of return. This represents the net growth, net internal rate of return year over year, annually. So for example, if you said, hey, I earned 20% in the stock market last year, this would represent, it isolates each year what you earned last year, what you earned this year. It does not take into account the average return over the life of the policy. We do have other videos on that if you're interested. So as time, you see it growing. But then we've got the taxable equivalent. So this is a question a lot of people often have is, hey, what do I have to earn in a separate account? Right? If I'm earning 8% in the market or elsewhere, but I'm in a 35% tax bracket, and we can easily adjust the tax brackets. What does a, call it 5.4% tax-free return equate to if I'm in a 35% tax bracket? Well, I would need to earn 8.35% for that year, because this is the annual internal rate of return, in a taxable account to obtain the same tax-free equivalent. Then also, remember the theme of this video, peace of mind. I've got the peace of mind product here as well. I'm not saying this is bad. A lot of people we work with have done very well in the market. You know, we often see individuals take one side or the other as far as buy term and invest the rest, S&P 500 mutual funds are the king and life insurance stinks. And you've got life insurance guys that say life insurance is the king, everything else stinks. Now, everything has pros and cons. See how you can work together, work in conjunction with each other, and put yourself in the best possible position, rather than just say, my way's the best. Like, no, we got to look at the pros and cons, man. That's the fun part. So this is based off of a 40-year-old male, present dividend rate environment. Let's look at the guarantees. All right, here's what I want to see. Worst case scenario, exact same product, break even's a little extended. This assumes that the company pays no dividends from day one. Absolute worst case scenario. $1 million in, breaking even. Year 6 basically, between 5 and 6. Annual internal rate of return. Why it jumps here, if you are technical or interested in the technical details, so year 7 you'll see that jump. What we did here was what is called a reduced paid up option, which eliminates the base premium altogether. So here you technically still have a $25,000 base premium that's due years 5, 6, and 7. The net out of pocket is 0. He's not paying it at all. What's happening is the dividends and interest are paying the premium for him. That way it's covered, out of pocket 0. Cash value still grows, but there's drag. It's got to satisfy that premium first. Once we chop it off, you see there's no drag, growth picks up. Guarantees with the tax benefits, I mean, hard to find a bank account like that. Not saying this is a bank. We have a nice sized death benefit as well. And when we look at the taxable equivalent, very healthy over time too. So point being here is we've got the peace of mind product that just shows the stability, guarantees the growth over time. But it's really the question is, does it fit with what you are doing now or what you want to accomplish? Whether you want to continue to feed the beast, if you want to keep feeding the policy, or if you want to start after a short period of time, you can design it to be very flexible. So if you have questions, reach out anytime. We'd love to connect and work with you. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.